contract of insurance. This concept in Unit 2 is asked for 10 marks. This concept has also been asked in Unit 1 for 10 marks. So there are basically 7 principles of contract of insurance. The first principle is the principle of utmost good faith, which has the maxim oberema fides. This principle is sometimes asked for 10 marks in Unit 2 separately. The next principle is the principle of indemnity. This is very important principle as it sets a base for the upcoming principles. The next principle is the principle of subrogation. This principle is sometimes asked as a short note separately. The next principle is the principle of contribution. This principle is sometimes asked as a short note separately. The next is the principle of loss minimization. And after that there is insurable interest. So insurable interest is sometimes asked as a long answer for 10 marks in second unit. And the next principle is the principle of proximate cause, which has the maxim causa proxima, and it is asked as a short note in second unit sometimes. So we will see one by one all of the principles. In this video I have only covered the basic principles of contract of insurance. So we will see one by one all of the principles. So the first principle, the principle of utmost good faith with the maxim oberema fides. So what does it mean? It means that the parties to the insurance must deal in a good faith, and the parties should disclose all the material facts and circumstances to each other. So both the insured and the insurer, they should disclose all the material facts known to each other and all the material circumstances that they each other know. This is called principle of utmost good faith or oberema fides. This maxim is also derived from the caveat emptor, which means that let the buyer beware. So this is covered under the Marine Insurance Act 1963. So the section 19 of the Marine Insurance Act 1963 states that insurance is oberema fide, which means that both the parties in an insurance, both the insured and the insurer, should disclose material circumstances to each other. So the insured is the person who is taking the insurance and the insurer is the person who is giving the insurance. And what happens if the both parties do not disclose material circumstances? So if one party does not disclose any material circumstances to the other party, the other party can easily avoid the contract. Section 20 of the Marine Insurance Act 1963 states disclosure by assured. So what are the things that an assured should disclose to the insurer? The assured to the insurer should disclose every material circumstances, and the assured is deemed to know all the material circumstances in an ordinary course of business. So what do you mean by material circumstance? Material circumstance means any circumstance which will influence the premium and which will also influence the taking of risk by insurer. So if the assured he tries to influence the premium, that is he tries to reduce the premium by not disclosing any material circumstance, then the contract is not done as oberema fides, it is not in good faith, and also it should not influence the taking of risk by insurer. The next is what are the things that an assured should not disclose to the insurer, that it is okay if the assured do not tell it to insurer. Things are circumstances that diminishes the risk, circumstances which the insurer is already deemed to know, and the information which an insurer has already waived, that he has already said that he does not want to listen it. The next is superfluous to know to insurer reason of express or implied warranty, that it is superfluous to insurers, it is useless for the insurer to know, then that material circumstances the assured it is not for him to tell. The next is material circumstances is a question of fact. And circumstance, what do you mean by circumstance? Circumstances is the information received by the assured. It's called circumstance. The section 21 of the Marine Insurance Act states that disclosure by agent affecting insurance. So what are the things that agent should disclose to the insured? The agent should disclose every material circumstance to the insured, to the person who is taking the insurance. And the agent should disclose every material circumstances that the assured is bound to disclose. So he should tell the assured that these are the things that he need to tell him. So that all that he should disclose, the agent should disclose. There is a case law, Lakshmi Insurance Co. versus BB Padmavati. In this case, it was held that insurance is oberema fides. That is, both the parties should disclose material circumstances to each other. In this case, it was held. So this was the first principle, oberema fides. It is sometimes asked as a 10-mark question. The next principle is principle of indemnity. So what is principle of indemnity? The definition is given under section 124 of the Indian Contract Act 1872. So indemnity is a contract where one party promises to save the other from the losses occurred by the conduct of the promiser himself or by the conduct of any other person. It is called contract of indemnity. And insurance is a contract of indemnity. Classification. The classification is done as indemnity contracts and non-indemnity contracts. So what are the indemnity contracts in a contract of insurance? All the insurance which are not life insurance are called indemnity contracts. All the insurance which are not non-life insurance or which are not life insurance are classified as indemnity contracts. Only life insurance are non-indemnity contracts. So why are life insurance non-indemnity contracts? See, in an indemnity contract, the value for the loss is fixed. The indemnifier will give a fixed value to indemnity holder when losses occur. But in life insurance, there is a subject matter is human life, and human life does not have any value. You cannot name a price to human. So that is why life insurance are non-indemnity contracts, because human life cannot be valued. They cannot be valued in terms of money, and all the property and every other stuff has a value to it. So that is why they are indemnity contracts. This is the only reason why life insurance policies are non-indemnity contracts. There is a case, there are two cases actually, Dalby versus India and London Insurance Co. In this case, it was held that fire and marine insurances are contract of indemnity. The next case is Dalby versus India and London Assurance Co. In this case, it was held that life insurance is not a contract of indemnity. The next principle, principle of subrogation. So what do you mean by principle of subrogation? Principle of subrogation means transfer of rights and remedies of insured to insurer who has indemnified. So what happens is, when the insured takes a policy from insurer and the loss happens to insured, so what insured does is he brings the insurer in his place to pay for it. So this is principle of subrogation. The insured replaces himself from the insurer to pay the liability. That is, he is transferring his rights and remedies and liabilities to insurer. This is called principle of subrogation. What are the essentials of principle of subrogation? Principle of subrogation is corollary to the principle of indemnity. So it is a corollary to the principle of indemnity. It has to follow principle of indemnity. So what happens is, for example, say the fire happens and the property gets damaged, burned, and the insurer will pay full amount of the damage caused up to the premium to the insured. So what the insurer does is, after paying the full payment, the remnants of the property from the fire, the insurer will claim it. The left property is taken by insurer, because if insurer pays him full money and also give him the remaining the property, then the insured will get extra benefit, and which is against indemnity, the contract of indemnity. Because in contract of indemnity, the indemnifier only gives up to the loss, not more than that. So that is why the insurer, after paying all the money, he will take the remaining property to himself. The next is subrogation is substitution. So subrogation is a kind of substitution where the rights of insured or all of the rights of insured are transferred to insurer. Subrogation only up to the amount of payment. So the insurer is subrogates only up to the amount of payment. That is only up to the amount of premium. The subrogation may be applied before payment. So the basic principle of subrogation can be applied even before the insurer pays. So how this subrogation is applied before the payment? Say for example, the insured occurs a loss, but he has a compensation from third party for that loss, and he receives that compensation. Then the insurer has the right to reduce that compensation and only pay the remaining balance. The next essential of principle of subrogation is it does not apply to personal insurance. So personal insurance is a kind of life insurance, and the principle of indemnity does not apply to life insurance. So that's why principle of subrogation does not apply to personal insurance. All of these rules are mentioned under Section 79 of the Marine Insurance Act 1963. There is a case law, Bernard versus Rodokanachi. In this case, it was held that if the insurer pays excess amount to the insured, then the insurer can get that excess amount back. The next principle is principle of contribution. So what do you mean by principle of contribution? It is a right of insurer. So it is the right of a insurer, the person who is giving the insurance. It is the right of insurer to receive proportionate amount from other insurers liable to pay for some loss. So it is a right of insurer to receive proportionate amount from other insurers. So what happens in this is, say for example, an insured person, he is insuring for accident, but he does not take insurance only from one company, he takes insurance from different companies. So he has claim from different companies, and the accident happens, and if he goes on and try to claim insurance from every company, then he will make a profit out of it instead of loss. So to prevent this, what they have done is they have brought the principle of contribution. So what happens in this is, if a insured has taken multiple policies from different companies, so what these companies will do is they will contribute each other and pay only to the losses. Say he has taken insurance from 4 companies, so these 4 companies collectively will pay to the loss. Not he cannot take all amount from each company. He will have to take collectively from all of the companies. There is a case law, Mercantile versus Liverpool and London Globe. So in this case, it was held that why principle of contribution is necessary. So in this case, it was said that to prevent a man from recovering more than loss, and make the parties contribute to pay. This principle was brought. Illustration. Say for example, a person takes insurance from company A of rupees 5,000. He has occurred loss of 6,000, and he takes total insurance of 30,000. From company A he takes insurance of 5,000. From company B he takes insurance of 10,000, and from company C he takes insurance of 50,000. Total he makes an insurance of 30,000, and he suffers a loss of 6,000 rupees. Then all these 3 companies will equally contribute to pay the loss of 6,000. So from company A he will take rupees 1,000, from company B he will take rupees 2,000, and from company C he will take rupees 3,000 and take the loss of 6,000 rupees. Essentials. What are the essentials of principle of contribution? The subject matter should be same to all of the companies. The subject matter should be same. The peril or danger should be same. The peril due to which the accident has occurred should be same to all of the companies for the insurance. The interest covered should be same. Policies in force at time of loss. The policy is in force at the time of loss, and policies are legally enforceable. The next principle is principle of loss minimization. So what is principle of loss minimization? In this, insured, it says that insured, the person who is taking the insurance, should take necessary steps to reduce loss during uncertain event. So during happening of an event, or say for example, a bike driver, he is driving his bike and suddenly he suffers an accident, and during accident he should take extra care. He should take extra care to avoid as much accident as possible, to avoid as much loss as possible to his bike. He should take extra care. The next is insurable interest. The next principle is insurable interest. Definition: the subject matter of contract provides financial gain to insured and financial loss if lost. So, insurable interest is nothing but a subject matter of the contract of insurance. So, it is a subject matter of contract of insurance. The subject matter on which the insured is taking insurance is called insurable interest, and it should the subject matter is such that it provides a financial gain to the insured when he has them, and when he loses that he suffers a financial loss. So, it is called insurable interest. What are the essentials of insurable interest? It is enforceable by law. It should be enforceable by law. It has a right in property. So, insurable interest is a right in property. It is definite and pecuniary. So, it has certain value. It is definite. It must be lawful. In life insurance also, insurable interest is presumed to exist. So, life insurance does not have any value. But in life insurance, the insurable interest is presumed to exist and is unlimited. The interest in life insurance is unlimited because we cannot value human being. There is a case law, Reed versus Royal Exchange Assurance Company. In this case, it was held that the wife is presumed to have insurable interest in husband. The wife is presumed to have insurable interest in husband because husband is the one who provides the wife with all the food and stuff. So if the husband dies, then wife will suffer a total loss. She cannot maintain herself. So that is why wife has the insurable interest in husband. The next principle is principle of proximate cause. So it is based on the maxim causa proxima. So what is the meaning of it? The causa proxima means the immediate cause. Definition: it is the peril or danger against which insured has taken insurance. Say for example, due to multiple events, the damage occurs to the insured, but he only takes insurance only to certain events. So that is proximate cause. So the uncertain events for which the insured is taking insurance are called a proximate cause. So even if he suffers damage due to multiple reasons, only those reasons which he has taken insurance will be seen and is considered as a proximate cause, and he will be given insurance. That's all. This is half of the second unit. I will take the remaining in next video.